Welcome back to another episode of the Benefits Insider. I'm your host, Chris Hamilton, and today I want to expose one of the things that's causing your company to spend more on health insurance than it should. And it's one of the reasons and one of the secrets behind your rising costs that allow the carriers to profit more. They come back to you at your renewal for higher increases and they make more money in the process. And this is an easy tip that you can use to lower the cost of your health claims and thereby lower the cost of your health insurance program for the benefit of your company, adding more profitability to your bottom line, but it's also going to help your employees receive better benefits, usually in the form of reduced or even no costs out of pocket to your employees when they go to buy medicines. I want to talk about prescription drugs. And this is one of the areas that carriers profit the most when you look at their earnings every single year, and it's through these business units that they own called pharmacy benefit managers. You've probably heard a lot in the news recently about this. There was a lawsuit against Johnson & Johnson for breach of fiduciary duty because they're allowing high-cost prescription medications to be filled through their plan at the detriment to their employees and their company's bottom line in favor of benefit managers, pharmacy benefit managers. And it pertains to the costs of medications that are flowing through the plan when there's cheaper alternatives for other medications, even the same medications many of the time. The Wall Street Journal has done a really good job reporting on this. There's two articles that I'll link to in the comments as well, just to share that information with you. But these particular articles talk about why pharmacy benefit managers will allow and insurance companies allow higher priced medications to flow through the plan when the exact same medication is available at a cheaper price, and also how some medications are offered at a more expensive price and even a lesser price, but these insurance companies allow the medication to flow through at the higher price. They contract for the higher price. Why in the world would anybody do that? Particularly when you're fully insured, think about this. Doesn't the insurance company have incentive to help you lower the cost of claims? They'd be able to make more money, right? But that doesn't actually work in practice. The insurance companies, their profit margin is capped at 15% in aggregate on the premium that they take in. In essence, their profit margins are capped at what they can make. The only incentive they have on the surface is to try to escalate premiums up if they want to show a return to their shareholders. They want 15% of a larger number, which I've talked about and detailed in prior episodes. But today I want to share a little tip on how they're actually monetizing your claims and making more money in the process. So think about this. If they have to cap their profit margin on the insurance premium they take in, how do they solve to create more profitability for their shareholders? They have vertically integrated and they own the pharmacy benefit managers that you use. They force you to use them to generate higher profitability. So just to give you an illustration of vertical integration and how money is made in an industry, and this isn't just with health insurance, this could be your industry, for instance. On one end of the spectrum, you're going to have the providers. And this could be manufacturers. But in this particular case, we're talking about health care, not the insurance, just the health care. And that's going to be hospitals, that's going to be doctors, and that's going to be pharmacies. And in this particular case, we're talking about the actual health care. We're not talking about the insurance. This is just the provision of health care. These are the folks that provide the medical care. All the way back to the consumers. This is going to be employees. This is also going to be your company. But in the middle, we have all the middlemen in healthcare. And that is going to be the insurance companies. And that is going to be the PBMs. So if you are with one of the big insurance companies, you're either using CVS, Express Scripts, if you're with Cigna, this is going to be Aetna, Prime, if you're with BCBS, or Optum, if you're with UHC. If you look at these companies' earnings, this is where all the money is made. This is where the money is made by these companies. And how do they do it? Whenever middlemen get involved, they have the ability to set the contracted price they're doing two things. One, they have the ability to determine what drugs are covered. That's called their formulary. This is one of the biggest things that we hear from clients when you move from one carrier to another. My drug isn't covered, or it's no longer preferred. Well, why is that? So PBMs do two things. They're picking what medications are covered on your insurance plan, and then they set the price that your employees and your company are going to pay when they go to a pharmacy to get their medication. And oftentimes what we see, the decisions that they make aren't necessarily geared towards the benefit of you, it's geared towards the benefit of their bottom line, as highlighted here in these articles by the Wall Street Journal. So they do this in two different ways. One, they look at how they can set the contracted price, and they build in what's called a spread. Really simple concept. You have a product, you mark it up, and you get a profit from it. But the problem here is that these PBMs, pharmacy benefit managers, which are owned by the insurance company, they're not manufacturing the drugs, they're only setting the price and the preference. When I say preference, that's the drugs that are on the list. These are the ones that are approved for you to be able to purchase using their insurance. In the process of that, they make money two ways. One, they mark the price of that drug up. They tell the pharmacy, we're going to pay a certain price for the medication. The pharmacy's only getting a small cut of that medication. The rest of that money is going back into the insurer's pocket. Doesn't seem fair, does it? Because they're dictating to you the medication you have to take and the price that you're going to pay for it, and they don't disclose it in a very transparent manner. Well, the second way that they make money is through rebates. These are dollars that are paid by drug manufacturers to the insurance company or the PBM to get preferential treatment on their list. And so oftentimes if you were to interview, in fact, they did interview spokespeople from these PBMs. And I actually think this is one of the things that is plaguing our industry today. Everybody's talking about having the solution to the problem, which is rising costs. And the thing you really need to look at, if you're a manufacturer or you run a service company, you're thinking about what does it cost me to produce this good and deliver it to the customer. You're looking at the net cost. What do I pay to transact in this business? And oftentimes, the pharmacy benefit managers are not looking at lowest net cost. They'll talk about rebates and bringing rebates to you to help lower the cost of a medication. Well, I'll give you a perfect example. When you look at one that was highlighted in this article is Humalog. It's insulin basically for a diabetic. The plan will cover a drug that's $275 when the exact same medication is available for $25. So they'll talk about, well, there's a rebate available for it. We're going to be able to get you a big discount on it. Well, if you think about that for just a second, at $275, and you can get the exact same medication with no rebate for $25, is the rebate going to be more than $250? The answer is no. There's no rebate on that particular medication. They're not even providing that to you, but they're telling you in aggregate, let us look at this on a net rebate basis. But when we look at the data, it doesn't work out in favor of the client. So let me give you an example of what this might actually look like in your claims and how you can reduce the cost of medications. There's a real popular drug on the market today. You've probably seen it in your claims, called Humira. And this particular medication can run as high as $90,000 a year, which is $7,500 a month. The big PBMs, they're going to give this particular medication preferential treatment. And there's other drugs out there that you're going to start seeing here. It's going to be Skyrizi, it's going to be Stelara, Rinvoq. Now that Humira has come off patent, they're going to give preferential treatment to those medications as well. There are other medications with the exact same chemical makeup. Think about a generic. There's not a generic for these medications that are called biologics, but clinically, they're the exact same medication. There's one out there that we use with our clients. It's $750 a month or $9,000 a year. So when you look at these, there's an $82,000 delta in the cost of these medications. The question you have to ask, is there an $82,000 rebate associated with that particular medication? The answer is no. And when you look at those other medications that I mentioned, Skyrizi, Rinvoq, Stelara, they're not $90,000 a year. They're well into the mid and upper six figures for those medications. So I think it's important when we look at what do we offer our employees, how do we pay for it. This is one of the easiest areas to be able to address, but the big pharmaceutical benefit managers, pharmacy benefit managers, they're not doing it, at least not today. And because of that, it's important to be able to remove that misaligned incentive and the conflict of interest that these insurance companies have to manage their own programs. They're not doing it with your best interests in mind. There are a lot of PBMs that are popping up talking about being able to solve this particular problem. It's actually one of the things that I think is holding our industry as advisors back from helping companies like you, because everybody's talking about the same problem and talking about solving it, but very few people are actually trying to solve the problem. They're trying to protect themselves. When you think about pharmacy benefit managers, there's a lot of them that are coming out into the market with solutions, but not all of them are addressing it the same way. There's a handful of things that you really need to take into consideration and why you need an expert helping you evaluate those contracts, because at the end of the day, the contracts mean everything. These are people, everybody in the PBM industry is an expert about how the money is made, but nobody wants to show it to you. And very few people are willing to stand behind the contracts that they're issuing to your companies. Even if you're working with a mid-tier PBM that has programs in place, they're not all created equal. So there's several things that you want to look at when evaluating one of these PBMs if you're thinking about making a switch. So everything comes back to the contract. What is in that contract? How do they define the terms of that contract? What's a generic drug? What is a rebate? Most people think, and most PBMs think about it as one type of payment. But in fact, there's 5 to 7 different types of rebates, but many PBMs only give you access to one. And many PBMs won't pass through the entire rebate amount in your favor, and that's money that should be coming back to you, not to an insurance company and not to a PBM. The second thing you need to be considering is how are you going to hold that PBM accountable for their performance? Do you have a mechanism in place to track the guarantees that they've made to ensure that they're meeting the obligations of their contracts? So we talked about making sure we have a good contract, making sure terms are defined properly in your favor, but then also holding them accountable to that performance based on the terms of those contracts. And then the third thing that's vitally important is that formulary we talked about. Remember that list of medications? So when I think about formulary, I'm thinking about the list of medications that are covered. So in that formulary, oftentimes these contracts come with good drugs on them, fair price. Those formulary lists will also come with medications that are more costly. So we need a mechanism that's going to allow us to strike those out as first preference medications when a good alternative, essentially the same medication is available, or if it's the exact same medication at a lower price, we don't contract at that higher price for that medication. The only way to do that is to work with a mid-tier PBM that's willing to create a custom formulary for you, allow us to monitor the claims that come through, the utilization for your employees, and modify that as needed. This is essentially how you're going to be able to track the performance of a PBM, ensure that your employees are accessing the medications that they need at the fairest price, the best price that's available on the market. The reality is, at the end of the day, you need an advisor that understands how the games are being played. You can take 2 advisors, go to the same PBM, those 2 advisors are likely to get 2 different contracts. You have to know how to negotiate the contracts, the provisions that need to be into them, and most importantly, have the mechanism to hold those PBMs accountable to their performance for the betterment of your company. It helps reduce the cost of your health insurance claims, which reduces the cost of your health insurance program, increasing your profitability. Most importantly, it benefits your employees. Health insurance is a benefit. It shouldn't be a detriment. And employees spend entirely too much money out of pocket for their medications, and there are ways to lower them for the betterment of your company and the betterment of your employees. I hope this was helpful to you. I'll include a link to the Benefit Insider Playbook where we share our strategy that we use when consulting with our clients. But until next time, use these tips to add more profitability to your bottom line and more money in your employees' paychecks. Take care.